Welcome to Iron Financial, the explainer where we help you forge a stronger portfolio and cut straight through market weakness. I'm your lead analyst, and today we are running a high-stakes structural integrity test on an absolute market heavyweight. We're talking about Intuit. We are breaking down their Q3 2026 earnings, and let me tell you, the numbers are intense. Listen, this isn't just another software company, okay? Intuit is a foundational layer for both the corporate and consumer worlds. They are deeply, deeply embedded in the daily financial operations of literally millions of people. From the absolute smallest gig worker right up to massive mid-market enterprises, Intuit provides the essential plumbing. So when a foundation this massive starts making drastic, sweeping changes, the entire market feels the tremors. And I'm the Market Skeptic. I am here to ask the hard questions on behalf of everyone tuning in right now. We really need to know, is the hype real, or is this massive foundation about to crack? Because right now, Intuit is presenting us with one of the most fascinating paradoxes in the entire financial sector. We need to figure out if this is a solid, durable build, or just a structural value trap waiting to collapse on unsuspecting investors.
Okay, let's dive right into this paradox. On one side of the ledger, Intuit just delivered an absolute sledgehammer of an earnings report. I mean, they beat revenue expectations, they expanded their margins, and they even raised their full-year guidance. By all traditional metrics, the company's operational foundation looks incredibly robust right now.
Yeah, but hold on. Here's where I have to step in and push for some clarity. How in the world does a company boast about scaling its growth engines and delivering durable revenue while simultaneously taking a literal wrecking ball to its own operations? They just announced a 17% cut to their full-time workforce. You absolutely do not gut nearly a fifth of your staff if everything in the blueprint is perfect. It is highly, highly unusual to see a thriving, profitable business proactively trigger a massive earthquake inside its own walls like this.
The bullish narrative out there really wants us to just focus on the headline numbers. But as an investor, you have got to look for the structural fatigue. And it's there. We are seeing a real deceleration in top-line growth. We're looking at existential threats from artificial intelligence potentially disrupting their core tax business. These are threats that could fundamentally alter the way individuals interact with financial software altogether. And now they're deploying a massive, deeply disruptive restructuring plan to combat it all. And that is exactly why we are initiating this stress test today. We're going to dig into the raw data, we're going to inspect the financials, and we will determine if these restructuring moves reveal deep cracks in Intuit's foundation, or if management is simply clearing out the dead weight to forge a much stronger, leaner machine for the next decade. Because building a leaner machine means stripping away legacy overhead and reallocating that exact capital straight into the engines of future growth, like AI and international expansion. But first, we really need to examine what is currently holding the roof up.
Let's initiate the drill down. To truly understand Intuit's structural integrity, we have to follow exactly where the capital is flowing. We need to analyze its core load-bearing pillars. The data shows Global Business Solutions is doing the heavy lifting here, driving 55% of total net revenue. Right, and that leaves the consumer segment, which includes the famously massive TurboTax and Credit Karma brands, holding up the remaining 45%. You know, people still think of Intuit as just a consumer tax software company, but the capital flow clearly proves they've transformed into a massive business-to-business platform. But the real question remains, are both of these pillars actually bearing the load efficiently?
They absolutely are. And the top-line strength proves it without a doubt. Total net revenue for the third quarter of fiscal 2026 hit an impressive $8.558 billion. Think about that number for a second. That represents a very solid 10% year-over-year growth. In a macroeconomic environment that is still fraught with shifting interest rates and corporate tightening, adding that kind of structural weight to your revenue base is notoriously difficult to achieve. It is a massive testament to their pricing power and the essential nature of their services. When you are moving over $8.5 billion in a single quarter, your core product is deeply entrenched in your customers' lives. It shows true, durable inflation resilience.
Now, let's do the heavy quantitative lifting. Breaking down the GAAP versus non-GAAP metrics reveals the true torque of this engine. GAAP operating income grew 8% to over $4 billion. GAAP earnings per share spiked 11% to $11.09. And if we evaluate the non-GAAP EPS, it's sitting at a phenomenal $12.80, which is up 10%. Market Skeptic.
Look, I'll admit, the base is highly profitable. They're converting that top-line revenue into bottom-line earnings very efficiently. But I have to push harder on that operating income number. Revenue grew by 10%, but operating income only grew by 8%. Guys, that is margin compression. The structural steel is facing friction. For a company priced for hypergrowth and trading at a premium multiple, single-digit growth on the operating line can really start to look like the core temperature is cooling off.
Let's drill down deeper into the consumer segment to see where the torque is really being generated. Total segment revenue grew 8% to $5.3 billion. TurboTax alone brought in $4.4 billion, growing at a steady, reliable 7%.
Market Skeptic. 7% on TurboTax is decent, sure, but what is genuinely shocking here is Credit Karma. That segment surged 15% to $631 million. Given the current high interest rate environment, where credit card debt is immensely expensive and mortgage rates are acting as a massive headwind across the board, seeing 15% growth in personal and home loan recommendations is remarkable. It's completely counterintuitive to the broader macro data. Meanwhile, ProTax is totally flat at $278 million. So the consumer tax side is stable, yes, but it's the financial product recommendations driving the real structural momentum here.
And if Credit Karma is momentum, Global Business Solutions is the pure engine block. This segment is executing incredible heavy lifting. Total revenue here was $3.3 billion, up 15%. But the real structural power? That's in the online ecosystem, which surged 19% to $2.5 billion. And let's focus on QuickBooks Online accounting revenue for a second, which jumped a massive 22%.
Yeah, that 22% is undeniable, but where exactly is it coming from?
Management noted this was driven by higher effective prices, steady customer growth, and a massive mix shift toward higher-tier offerings. This is absolutely crucial to understand. B2B software like QuickBooks represents an incredibly sticky foundation. The switching costs are astronomically high. Once a small or mid-market enterprise has built its entire financial reporting infrastructure on QuickBooks, they rarely tear out the foundation to switch to a competitor just to save a few dollars. That dynamic gives Intuit immense, durable pricing power.
But here is the crack in the armor I simply cannot ignore. The momentum is clearly decelerating. In the second quarter of fiscal 2026, total revenue grew by 17%. Now in Q3, that growth has dropped down to 10%. That is a significant, rapid slowdown in velocity. When top-line growth starts to decelerate that rapidly quarter over quarter, you have to ask if the structural steel is starting to fatigue. Is the market becoming saturated, or are they losing ground to more agile competitors?
That deceleration is exactly what management is attacking right now. They aren't waiting around for the foundation to settle and crack. They are proactively and aggressively re-engineering it.
Which brings us to Section 1, heavy lifting. The 17% workforce cut.
This brings us to the most aggressive and frankly controversial move in Intuit's entire playbook. We really need to unpack the sheer scale of this number. 17% of their full-time workforce is being eliminated. We are talking about roughly 3,000 jobs being cut from the payroll. This isn't just a minor trim around the edges. This involves completely closing down their Reno and Woodland Hills offices and deeply streamlining their engineering and product organizations. From a cultural and operational standpoint, this is an earthquake. Winding down entire sites disrupts daily operations, it severs deep institutional knowledge, and it absolutely tanks employee morale.
I hear the skepticism, and obviously the human cost is very real. But as an analyst, I look at management's exact blueprint here, and it makes clinical, strategic sense. CEO Sasan Goodarzi stated they are at an inflection point. This restructuring is strictly designed to make Intuit a faster, leaner, and more focused company. They are not just hoarding the savings, they are actively reallocating capital to scale growth engines across their big bets. For example, they are cutting middle management to aggressively hire top-tier engineering talent specifically for their AI initiatives. This is about operating with far greater velocity. By sharpening the cost structure right now, they are heavily reinforcing the foundation for durable long-term margin expansion. It is painful, absolutely, but it is necessary for ultimate structural integrity. Yeah, but that long-term margin expansion comes with an immediate, extremely heavy price tag. The direct financial impact on the ledger is estimated to be between $300 and $340 million in restructuring charges, hitting primarily right now in the fourth quarter. These are real, hard costs, severance packages, benefits, and site closures that drastically drag down near-term profitability. You're paying a massive premium today for the promise of a leaner structure tomorrow, and that introduces serious execution risk. What happens if the severance payouts and the resulting lost productivity drag out much longer than anticipated? If they fumble the integration of these new AI engineers, that $340 million hole doesn't fill back up anytime soon.
Let's move to Section 2, Stress Test, the AI threat.
Execution risk is always present, for sure, but management believes absorbing that risk is absolutely necessary to face an even bigger existential challenge. Intuit isn't hiding from the rapid evolution of artificial intelligence. They are structurally leaning right into it. Sasan Goodarzi directly attributed their strong third-quarter results to their AI-driven expert platform strategy. They have built a proprietary generative AI operating system, or GENOS, specifically for their internal developers. Think of GENOS as the high-tensile rebar for their new digital infrastructure. It allows their internal teams to build, test, and deploy financial applications with unparalleled speed, melding cutting-edge AI capabilities with deep human expertise. They view AI not as a wrecker of their business, but as the core building block of their entire future.
But I have to aggressively interrogate this premise. Is AI actually building a new moat, or is it silently eroding the one they already have? We know they are building done-for-you AI agents, but think about it. If an AI can eventually do your taxes flawlessly, doesn't that directly cannibalize Intuit's lower-end, price-sensitive tax preparation market? The data is already showing cracks. Their TurboTax online units are projected to decline by 2%, and their pay-nothing customers dropped from 8 million to 7 million. In the software world, this is called the freemium funnel. If free AI bots automate the easy stuff and you lose 1 million top-of-funnel users, you eventually starve the higher-tier paid services downstream. Volume takes a massive hit, and eventually that deflationary pressure moves right up the chain.
That exact fear of a deflationary spiral is why they aren't relying purely on automation. Intuit's defensive strategy perfectly rebuts that fear. Their core formula is AI plus human intelligence equals trusted financial intelligence. Listen, a basic AI language model doesn't have a moat. Literally anyone can query it. But an AI model is only as powerful as the specific data it is trained on. Intuit has proprietary, highly sensitive historical tax and accounting data from over 100 million customers. When you combine that massive, exclusive data moat with domain-specific AI and back it up with a massive network of verified human experts, you create something uniquely valuable. When a business's entire financial life is on the line, they do not want a generic hallucinating chatbot. They want verified, trusted intelligence. That specific combination creates an ironclad moat that open-source competitors simply cannot breach.
Fair enough. Let's shift gears to Section 3, the core, capital allocation.
Okay, let's assume the moat holds against the AI disruptors. We still need to inspect the company's financial vault. Can their balance sheet actually withstand the massive operational turbulence of a $340 million restructuring plan while battling these structural shifts? Well, the reserves are rock solid. When we evaluate their financial foundation, they're holding $6.8 billion in cash and investments against $6.2 billion in total debt. That is an ironclad balance sheet. They are net cash positive. In a high interest rate environment, being net cash positive gives management immense strategic flexibility. They have the pure capital required to fund daily operations, effortlessly absorb those restructuring charges without borrowing a single dime, pursue strategic acquisitions, and most importantly, return massive value to shareholders.
And they are returning that capital aggressively. During the third quarter alone, Intuit repurchased $1.6 billion of their own stock. But the true signal of foundational strength is the brand new $8 billion share buyback authorization just approved by the board. You do not authorize an $8 billion capital return program unless management and the board have absolute, forged-in-steel confidence in the future cash flows of the business. An $8 billion buyback acts as a massive structural floor for the stock price. Furthermore, buying back shares aggressively during a period of perceived structural weakness or post-layoff dips is a hyper-efficient use of that fortress balance sheet.
To top it all off, they just raised their quarterly dividend by 15% to $1.20 per share. For me, as the lead analyst, this is the ultimate proof. Companies that are structurally failing or truly terrified of AI disruption do not raise their cash dividends by 15%. This confirms management's foundation is solid and their cash flow generation remains wildly durable.
Okay, I have to concede that point. You literally cannot fake a 15% cash dividend raise. The cash flow is undeniably there, backing up the massive balance sheet, even if the cultural foundation is shaking from the layoffs.
Let's bring it home. Section 4, the verdict, trap or opportunity.
So, we have a fortress balance sheet, but we also have a company actively firing thousands of employees while near-term growth slows. It's time to bring this analysis to a head and render a verdict. To do that, we must review their newly upgraded blueprint. Management confidently raised their full-year 2026 guidance across the board. They are projecting revenue between $21.341 billion and $21.374 billion. That implies 13 to 14% total growth for the year. Remember those deceleration concerns earlier? A 13 to 14% forward guidance is incredibly bullish and signals that Q3 was a temporary lull, not a structural collapse. They expect non-GAAP operating income to stretch up to $8.8 billion and non-GAAP EPS to hit up to $23.85. The forward-looking metrics are forged perfectly. The company is definitively telling us the structure will not only hold, but it will accelerate.
Here is my final assessment. The foundation is undeniable. You have a massive EPS beat, upgraded forward guidance, immense sticky pricing power in their B2B QuickBooks segments, and an aggressive $8 billion capital return program defending the stock. They are executing the hard, painful work right now to secure a dominant future. The proprietary data moat paired with AI is a winning formula. And here is my assessment. The cracks in the armor are equally real. Top-line revenue growth undeniably decelerated from 17% down to 10% in the near term. The execution risk of slashing 17% of your workforce creates a massive shock to the company culture that spreadsheet logic often ignores entirely. And finally, the AI disruption threat is an ever-present deflationary force that could permanently erode their lower-end tax volume over the next 5 years.
And that brings us to the ultimate question for everyone watching Iron Financial today. We've shown you the load-bearing pillars and the stress fractures. With shares potentially offering value relative to historical multiples, is this a buy-on-the-dip opportunity where you can lock in value on a solid, highly profitable platform? Or, with the dust still settling from a 3,000-person restructuring and AI aggressively looming on the horizon, is this a structural value trap that you should completely avoid? Are you forging a position or staying out of the dust? Dive into the numbers, weigh the structural integrity, and decide for yourself. Let us know in the comments if you are forging a position or staying out. Until next time, keep your foundation solid.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.